Average what? It's like 8. Right.
Yeah, that attachment you said something like I couldn't.
Which attachment?
Yeah, attachment of the distribution.
I didn't send an attachment for quiz 3. There's an Excel. That's a solution. There was a solution. I definitely didn't do a distribution because, you know. Okay, folks. I don't even want to remind you what's coming. You know, you already know. So no. So the project is hopefully reaching its final state. I'm checking the master spreadsheet because I can tell where the class is by looking at the numbers as they fill in. Now, please don't, you know, when you enter the numbers in, just follow the unit suggestions I made. If a number is a percentage, please don't enter it as a decimal. I know it's not a big deal, but it just means there's one additional step for me to make sure that I can compare the numbers. So just enter the numbers as you get them. You got until Sunday. I need them by Sunday night to do the presentation for Monday. And I'll leave the window open as long as I can, because at some point in time, I've got to take the Google spreadsheet, put in, download as an Excel spreadsheet and do the number crunching. So when you have your numbers, send them in. The last phase of your project, of course, is the valuation. And I want to start by re-emphasizing what I said in my last class, which is valuation is not an Excel spreadsheet. You just don't plug numbers. You're telling a story about your company. In some cases, the story is an uplifting story because you're talking about a company where you see great growth potentials. You're valuing NVIDIA. Your story might be built on AI is coming and NVIDIA is in the right place at the right time. And that's why I think NVIDIA is worth a lot. If you're telling a story about Coca-Cola, the story is going to be a pretty boring story, right? I mean, you can't make a story exciting just because you want to. You're not a creative novelist. You're talking about a real company. And if you're talking about a company that's on the downturn and you essentially are valuing Target and you say, you know what, the best days of Target are way behind them. And at this stage, they're just slogging along, hoping for some end game here. It's a depressing story, but it's a story that reflects what you think about the company. That story is what's going to drive what you use as input. So today I'm going to talk about the mechanics of inputs, but as I talk about the mechanics, I want you to think about what the story is that drives the mechanics. So let's look at the inputs that go into valuation. So if you break down a valuation, Tariq, your question? Price. No, but when you see value, when you say valuation of sports franchises, yeah, the only place I've seen them is Forbes, and it's not a valuation, it's a pricing. You know how they come up with the pricing? Anybody want to tell me? Go ahead. Guess based on what though? It's based on transactions. So for instance, the minute the Washington Redskins get sold for, what are they talking about? 6 to 7 billion, the Dallas Cowboys are going to become 10 billion. Because in a sense, they're doing relative pricing. It's not that unsophisticated. They're doing what analysts do with stocks, right? PE ratios and comparables. I'm not sure they're on weaker ground than a typical analyst. The only problem is there aren't that many transactions. All you need is one stupid guy overpaying for something and everything will get pushed up. Okay. So this is, so Forbes does a pretty good job of pricing. I wish they did not use the word valuation when they talked about the franchises. Why are the Yankees the most valuable franchise? In baseball, it's because they have the biggest media market. Because yes, delivers a huge amount of revenues, but it's all pricing based on other franchises. Yeah, and this is just an aside. In my other classes, somebody valuing Manchester United, and they're having real trouble getting the value even within 25% of the price. They're playing every game they can. Let me lower reinvestment, increase growth rate. And I say, it's time to give up. It's time to walk away and say, this company is priced at 4 times its value, and that gap is never going to close. You know why? Sporting franchises are not priced as businesses anymore. Now, why does somebody want to own the Washington Redskins? It's not because they expect to make money. What do they? It's a toy. Have you seen Steve Ballmer on the sidelines of the Clippers? Do you think this guy ever had this much fun ever while he was CEO of Microsoft? It's a $3 billion toy. It's an expensive toy, but you're worth $15 billion. This is the best toy that you've ever had in your life. As long as the number of billionaires who want to have fun exceeds the number of professional sports franchises, there will be no connection between what you see for the price of a franchise and what you get as a business. I told you I would talk to the Mets next week, and this is the point I'm going to emphasize. This is not a business. It is a toy or a trophy asset. Steve Cohen doesn't expect to get dividends from these holdings. I don't think so. Not in cash. He expects dividends in the form of, well, give me a World Series champion, something to show. But it is interesting because it does mean that the decisions you make as a sports franchise are going to be driven by whatever increases your pricing. Let me hypothesize that if you take the pricing of franchises that you see on Forbes and you looked at the social media presence of each team, that there'd be a high correlation. The teams which have the biggest mentions on Twitter and Facebook are also the teams which have the highest pricing. So you know who you should sign next? The person with the biggest Twitter following. Not the best player that you can get. I mean, it's a strange place we're in. Mike Trout is a less valuable addition to a team than somebody who sends off tweets when he's drunk and essentially get 20 million followers. I know it sounds strange, but when you see teams paying absurd amounts for players, how do you justify it? You can't justify it on a financial basis. It's a trophy asset signing. So it does mean that the Art Rooney Pittsburgh Steelers model is kind of dead in football. Art Rooney ran the Steelers as a business. He needed to make money because this was his business. That's no longer going to be the case. And whatever owners are left over from that old tradition are going to get, I wouldn't say pushed out, because they're going to get pushed out with a lot of money. But you're going to see, my prediction is by the end of this decade, almost every major sports franchise is going to be held by somebody who just wants an expensive toy or a trophy asset. Okay? The Packers are owned by, does everybody know who owns the Packers? It's owned by Green Bay. I tell you, if you wanted to make every Green Bay resident wealthy, all you need to do is sell the Packers for $6 billion. I don't know how many people live in Green Bay, but it's an anomaly because of the way it was structured, because they wanted to make sure the team never left Green Bay. I mean, would you want to be an Oakland A's fan? I think, in fact, one of the things is we're going to talk about what's the mission for a team. So the Mets, you might say, our mission this year is to win the World Series. You know what the mission for the Oakland A's this year is? To make Oakland so absolutely unpalatable that they can move. They had a possum in the broadcasting booth. People were complaining. I said, this makes complete sense. Let a possum loose. Say, look, this stadium is completely out of control. Possums are loose. I mean, I wouldn't be surprised if they let the Oakland Zoo to get all the animals into the stadium and say, eat a couple of thousand spectators while you're here. There are only 6,000 of them anyway. And then we can go and say, Las Vegas looks so much better. It's a very strange place to be in professional sports. I'm not sure it's healthy for professional sports, that everything is a trophy asset, but that horse has left the barn. There's nothing you can do about it. The game has become, I mean, this is true not just in the US with professional franchise, it's true in the UK as well. People complain about who owns Chelsea, Russian oligarch, right? I mean, you want it as a toy, they're the only ones who can afford a $3 billion or $4 billion or $5 billion toy. This is happening in professional franchise. In India, it's happening with IPL teams, which is essentially a trophy asset. If you're an Indian movie actor and you say, look, I've arrived, you buy an IPL team. So it's an aside, but there is a story there, but it's a pricing story. So once you start with the story and think about the inputs, here are the inputs that drive your value. You boil every valuation down, you need cash flows. Those cash flows can either be before debt payments, which are cash flows to your business, or cash flows after debt payments. Cash flows from existing assets. Second, you need growth rates. That growth rates have to be either in equity earnings, like net income, if you're doing an equity valuation, or an operating income, if you're doing a firm valuation. You need a discount rate. The discount rate can be a cost of equity, if you're doing an equity valuation, or a cost of capital, if you're valuing the entire business. And you need that closure. And we talked about why you need the closure. When will my firm be a mature firm? Cash flows, growth rates, discount rates, terminal value, right? So those are the mechanical pieces that go into valuation. So what I'd like to do is talk about each of those pieces. And as I talk about them, if you get a sense of deja vu, that's good, because we've talked about these same issues in the context of capital budgeting. Capital budgeting is just, it's valuation with structure, right? You're looking at a project. Everything we said in the context of the Disney theme park, you're going to see play out when you talk about valuing a company. You just have more loose ends to tie up. So let's start with cash flows. Cash flows can either be cash flows to equity or cash flow to the firm. Cash flow to the firm is a pre-debt cash flow. So you start with operating income rather than net income, because you want to look at earnings before interest and taxes. You act like you pay taxes on that operating income, even though you don't. It's a hypothetical tax. So what would I have paid as taxes? And this is a term that has different consulting firms. McKinsey calls it NOPLAT, but it's basically after-tax operating income. From that, you subtract out what you put into the business. In long-term assets as net capex minus depreciation, and in short-term assets, change in working capital. That's pretty much what we did for the Disney theme park, right? You start with after-tax operating income, you add depreciation, you subtract capex, you subtract change in working capital. That's free cash flow to the firm. You're saying, what about cash flow to equity? Well, yesterday Warren Buffett talked about dividends and how a big chunk of his portfolio is in stocks that pay dividends. And the old-fashioned way of thinking about cash flow to equity was the only cash flow you actually see, the only tangible cash flow you get from the company is dividends. You focus on dividends. But as an entire discussion of dividend policy said, companies don't always pay out what they can afford to in dividends. So the alternative to dividends is potential dividends. What are potential dividends? Potential dividends are essentially what's left over after you've met every conceivable need, which is free cash flow to equity. Put the free cash flow to firm and free cash flow to equity calculations next to each other. They both start with earnings, right? Free cash flow to equity starts with net income. Free cash flow to the firm starts with after-tax operating income. You still subtract out the same two items, net capex and change in working capital. But with free cash flow to equity, there's one final item. You have got to bring in the cash you get from debt and the cash you have to pay out, because you're thinking like an equity investor. So dividends are one extreme, free cash flow to equity the other. There's an intermediate choice where you can say, look, I'm too lazy to compute free cash flow to equity. I know companies don't pay out what they can afford to in dividends, but maybe if I add buybacks to dividends over time, that's going to give me a rough estimate of free cash flow to equity. So three choices for cash flows to equity, one for cash flow to the firm. So two of my companies, I'm going to use an equity valuation approach. One, in a sense, I have no choice. When I value Deutsche Bank or any bank, your only choice is to value equity. Why? Because debt is raw material. It's not a source of capital. And we've run into this issue repeatedly with banks, right? We can't compute a capital structure. We can't do a levered beta. And that plays out here as well. In 2007, I valued Deutsche with a dividend discount model. When you use dividends, what are you essentially assuming? That banks are run by sensible people and they pay out what they can afford to in dividends, and you don't have to worry about risk because regulatory. So this was, think of this as my time of innocence, when I thought banks were run by sensible people and the regulatory framework worked. I'm going to go with dividends. Makes life a lot easier, right? No estimation to do, you take the dividends. And in 2007, they paid out dividends of $2.146 billion. So this is before the 2008 crisis. They had no idea of the train that was heading towards them. They were paying big dividends. In 2007, when I valued Deutsche, I had no idea either that the train was heading towards them. With Tata Motor, in October of 2016, though, when I looked at Deutsche Bank, I said, look, I can't trust dividends. And Deutsche was in enough trouble that they weren't even paying dividends to begin with. So there I went with that alternate measure of free cash flow equity that I came up with for banks. Remember, where you start with net income and you subtract out what they have to reinvest in regulatory capital as their equivalent of net capex. And the free cash flows equity that I got reflect the fact that they're deep in the hole. So this is right after they'd lost money for 6 years in a row. They'd suspended dividends, they were losing money, they were continuing to lose money, and they had a $15 billion fine imposed on them by the Justice Department for something they did in $8 billion. They were deep in the hole. And essentially the only way I could dig them out of the hole is by investing enough in regulatory capital to save them. So if you look at my free cash flows to equity, they're negative for the first 4 years because based on how deep the hole was, I had to come up with new equity to cover the difference, and they were continuing to lose money. Do you see the advantage of a free cash flow equity model is it now gives you the freedom and the flexibility to deal with undercapitalized banks, troubled banks. Whereas if you use a dividend discount model, you hit zero and that's it, right? You can't go below zero. And that basically overvalues the bank because these are banks where you actually have to come up with fresh equity to go. So dividends in 2007, free cash flow equity in 2016. I mean, today I actually almost never use a dividend discount model with banks. I don't trust any bank to pay out what they can afford to. I'm going to try to compute free cash flow equity because I think it's a more reasonable way of thinking about banks. As you probably know, regional banks have lost 75% of their market cap in the last 3 months. This is the SVB effect, right? Silicon Valley Bank goes under, deposits are leaving, small regional banks going to the bigger banks. You're seeing that effect play out in a huge drop in market cap. And I would argue that some of these regional banks are probably being unfairly put together in the pile and the price is getting knocked down. Because I don't see a scenario where regional banks are going to disappear in a year, but they're going to be fewer regional banks. And if you can pick the ones that actually have a greater chance of survival, who knows? This might be the time to buy a good regional bank. So let's focus on dividends in 2007, free cash flow equity. With Tata Motors, I used a more conventional measure of free cash flow equity. What is a more conventional measure? You start with net income, you subtract out net capex, you subtract change in working capital, you bring in debt. I get essentially, the free cash flow equity each year. If you take in the capex minus depreciation plus change in working capital, that's reinvestment. You net out the debt. The rest has to come from equity investors. When you're doing equity cash flows, all you care about is what you have to come up with. So in a sense, that's why debt helps you. When you're looking at free cash flow equities, you're using it to cover some of your reinvestment needs. In fact, in the last column, I've computed what's called an equity reinvestment rate, the percentage of your net income that you're putting back into the business. That number can be negative if your equity reinvestment is negative. Right? But in this case, the equity reinvestment rate is negative because the net income was negative, but they continue to reinvest huge amounts. We're going to come back and use this equity reinvestment rate later in the valuation, but over the 5 years leading into 2013, Tata Motors has been pretty active in putting money back in the business. 88% of the net income they have has gone into the business. Is that good? Is that bad? We're not quite ready to make that judgment yet, but they are actively reinvesting. So they internally, at least within the company, they must see growth potential Whether it's good growth or bad growth, we'll have to make a judgment on, but they're putting a lot of money back into the business. So with free cash flow to equity, focus on cash flows left over. After debt payments, you look at what equity investors can take out of the firm. Free cash flow to the firm is a pre-debt cash flow. So let me go through that calculation for Disney. In 2012, the 12 months leading into 2013, they had $10.03 billion in operating income. Their effective tax rate was 31%. Remind yourself again what an effective tax rate is. The taxes divided by taxable income. So that's what they paid as a percent of taxable income. They had CapEx of $5,239 million, and that includes acquisitions. Acquisitions are just big CapEx, and depreciation was $2.19 billion. So if you take the difference between those two numbers, there's a huge net CapEx. Reflects the fact that they're putting money into, God knows, theme parks, new movie businesses, new acquisitions. That difference is net CapEx, and working capital went up by $103 million. So if you ask me to compute free cash to the firm, I'm going to start with the $10.03 billion. That's your operating income. I'm going to act like I paid 31.02% of that in taxes. Even though I don't, I get after-tax operating income. You subtract net CapEx, you subtract the change in working capital, you come up with free cash flow to the firm of $3.2 billion. Let me pause right there. When I say the free cash flow to the firm is $3.2 billion, where does that free cash flow go? What are the different places because those free cash flows don't stay in a lockbox, right? So what are the different claims that are going to be put on the free cash flows? First, you're going to make interest payments, debt payments. So any debt payments come out of the $3.2 billion. What else? Dividends you pay come out of that. Buybacks you get. This is your mother lode for everything you want to do. So this tells you how much cash is available to pay all the different claim holders, $3.2 billion. And in fact, I'm going to compute again a statistic I will need later in the process. Remember I said Tata Motors reinvests 88% of its net income back, and it's useful to know whether your company is actively investing or not. In the case of when I'm doing cash flow of the firm, if you add the 3,629 to 103, the change in working capital to the net CapEx, and remember my net CapEx includes acquisitions, that $3.73 billion is what Disney is reinvesting back into the business. I know making a big deal about reinvestment. Reinvestment by itself looks like a negative, right? It lowers your cash flows. I want to keep tabs on it because later when I talk about the good stuff that comes from reinvestment, the growth, I need to look at what they're reinvesting. The 32 divided by the 6.92 billion gives me a reinvestment rate of 54%. Again, I'm not passing judgment. Is it good? Is it bad? I don't know. I've got to bring the other half of the equation, which is how well are they reinvesting? But at least I have a sense of how much Disney is reinvesting. So when you look at your company and you see this reinvestment rate is low and has stayed low over time. Remember I said your company, you're telling a story about a company, you got to be very cautious about telling a growth story about your company. Do you see why? If your company is reinvesting very little each year, telling a growth story of 30% growth for the next 5 years and beyond becomes a lot more difficult to do, because how do you grow if you're not putting money back in the business? So the reinvestment rate will now become part of the ammunition used to design a story to tell about your company, because it tells you about what the company thinks about its own future. What is it putting back in the business? Can you have a negative reinvestment rate for your company? Can net CapEx be negative? Yeah, for any company in any year, depreciation can exceed CapEx. You're not put in jail for doing it. It's probably not a good idea if you're a growing company to do it year after year, but if you're a company in decline, that's actually going to be more par for the course, right? Your depreciation exceeds CapEx. Your net CapEx can be negative. Your change in working capital can be negative. You can be reducing working capital, which can make your reinvestment rate negative. Is that bad? Depends again upon the company. It depends on where you're in the company, but it is what it is. It tells you something about what's happening at this company in terms of invested capital and what the company is putting back. So any questions on the cash flow part? So cash flows can either be cash flows to equity, cash flows to the firm. You're trying to gain. It's not because you believe the future is going to look like, but you need to start with what you know. What did you do last year? What did you do 2 years ago? It's going to give you a sense so you can frame your story for the company. It's all about ammunition you can use to frame your story. So you got cash flows. Let's talk about discount rates. Very simply, if you pick cash flows to equity, you need a cost of equity. If you need cash flows of firm, cost of capital. At this stage, I'll also remind you what we said about the currency choice. If you decide to value a Russian company in US dollars, your cash flows have to be in dollars, your discount rate also have to be in dollars. That consistency issue that we talked about in capital budgeting applies in spades in valuation. And of course, the discount rate should reflect the risk in the business. Higher risk businesses should have higher discount rates. So let's talk about, again, the mechanics. And here you should really have a sense of deja vu, because I'm going to take the same numbers that I used when we talked about cost of equity and cost of capital in capital budgeting and use them now from a different perspective. The cost of equity that I estimated for Deutsche reflected a risk-free rate in euros, because I was doing everything in euros. A levered beta for banks. Remember, I didn't go through the process of unlevering and re-levering, and an equity risk premium based on where Deutsche does business. Remember, it's a global bank. Risk-free rate plus beta times risk premium, 9.23% in 2007. 2016, the euro risk-free rate had dropped to 0.1%. It's actually approaching zero. It was that first round with the euro risk rate. This is good, right? The risk-free rate has gone from 4% to 0.1%, but the cost of equity for Deutsche actually went up to 10.2%. Banks collectively became riskier after 2008. So when you looked at the levered beta you were getting from banks had gone up. And by 2016, I was saying, look, I can't use one levered beta for every bank. There are safer banks and riskier banks. So I actually created a distribution of cost of equity based again on observed numbers for banks. And I put Deutsche at the riskier end of the spectrum, the 75th percentile, because of what you saw in terms of what had happened to its tier one capital, the fact it was undercapitalized, was money losing. Today, if I value a regional bank, I'll probably use a higher cost of equity than the cost of equity I would use. So this is a scenario where you might want to break banks down into small regional banks and large money center banks and have different costs of equity for the two groups because they're different risk profiles. So again, it's a 2008 effect. Pre-2008, I would never have done this. I'd have treated all banks as a big pile, given them all roughly the same cost of equity. I don't think we're in that scenario anymore. For Tata Motors, the cost of equity calculation is going to follow the same script I followed when I did capital budgeting. I'm going to do my cost of equity in Indian rupees. Do I have to? I don't, but I made the choice to value Tata Motors in rupees, so I've got to stick with that choice. My risk-free rate in rupees is 6.57%. Remember where that came from? What did I start with? It's way back, week 3, week 4. I started with a Indian government bond rate. Then I did that little dance about default risk in that bond, and I took the default risk out. It's exactly the same dance I'm doing. Risk-free rate of 6.57%. The beta 0.964 came from a bottom-up beta. And the equity risk premium reflects where Tata Motors gets its business. Exactly the same process, because I'm looking at the same number from the outside in. When I did this for the cost of capital and capital budgeting, I was talking about hurdle rates that companies have to use within. I'm taking the same hurdle rate, and it's now becoming the hurdle rate I use as an investor in the company, because it is the same number. The cost of equity I get in rupee terms for Tata Motors is 13.5%. So stay currency consistent. Do exactly what you did in capital budgeting, because that's exactly the number you need. And finally, for Disney, this is actually the 4th time I've shown you the same slide, because it showed up in my capital budgeting section. It showed up as a lead into capital structure. If you remember, I said I showed the existing mix for Disney was 88% equity, 12% debt. There you go. Those are the cost of equity is based on a risk-free rate in US dollars. Why? Because I'm choosing to value Disney in dollars. I won't bore you by going through the details of how I got the beta, but I remember the bottom-up beta. We broke Disney down to multiple businesses, took a weighted average. That's a beta playing out here. And the equity risk premium of 5.76% came from looking at where Disney got its revenues. For the cost of debt, I did use the rating and I said, look, I could have done a synthetic rating, but even an actual rating, why go looking for trouble? That actual rating gave me a cost of debt of 3.75% net of the marginal tax rate. And here, notice I'm using two different tax rates. When I did my cash flows, I used the effective tax rate. Why? Because I'm looking at all of my income and looking at what do I pay as taxes on that income. When I do cost of debt, I go back to a marginal tax rate because interest saves me taxes on the margin. So if it looks inconsistent, the way to explain it is in one case, I'm looking at all of my income. In the other case, I'm looking at the marginal income. So the tax rate that I used was 36.1%, which is the marginal tax rate. Cost of debt of 2.4%, cost of equity of 8.52%. Those are the market value weights. Okay, so if you go back and review your packet one slide, whatever, when we did cost of capital, you'll see exactly the page because that's the same cost of capital playing out. One final point, and this is something you don't do in capital budgeting, but you should think about in valuation. You have a company, let's say you have a high growth company. You come up with the cost of capital for the company today. So it's 11%, right? It's all equity funded, high beta. What are you doing to this company? You're projecting out growth rates and cash flows in the future. And as you go further and further in time, what's happening to your growth rate? It's decreasing. You're moving it towards a growth rate of the economy, right? That's perfectly reasonable to do. But if you're changing the growth rate for your company, you're making it go from being a small, high growth company to a large, mature company. Intuitively, what should you expect to see happen to its cost of capital? I mean, you're at 11% now because you can't afford to borrow money. You're a risky business, you're high growth. But over time, what should happen, Dor? It should go down towards the cost of capital of the market. It's a practice that I find very seldom used in discounted cash flow valuation. Discounted cash flow valuation, people seem to think, I get one discount rate, I'm stuck with it. No, you're not. That's your discount rate for year one. If you think your company's business mix is changing or its geographical mix is changing, your cost of capital should change. And I'm trying to think of the last time I had a valuation where I could use one cost of capital. I can't even remember a company where I've been able to get away with one cost of capital. Maybe a Coca-Cola or a Kraft Heinz in steady state, mature, you can get away with it. But in most companies, costs of capital should change. In the case of Disney, I did assume it would change. And I assumed it would change partly because its debt ratio is going to go up over time. Why? Because remember, by the time I get to this valuation section, I already did the capital structure section. And what did we discover for Disney there? It's under-levered. It can afford to have more debt. I'm not going to push them to 40%. I don't think the management will, but I think over time, the debt ratio will drift up, which means your cost of capital, which starts at 7.81%. The existing cost of capital over time will drift down to 7.29%. In the case of Disney, it's not a big change. But if you gave me a company like Snowflake to value, I'd start the cost of capital. It'll probably be all equity funded, high risk, 12% cost of capital. But over time, that 12% will start to move. Now, in a sense, I'm trying to be internally consistent. It's not consistent to bring your company from high growth to stable growth, but leave it with the discount rate of a high growth company, because it's going to destroy your valuation. It's going to make your valuation lower. So leave open that door, because in capital budgeting, we got a cost of capital. We used it on a project because we were doing it on projects. Here, we're looking at a company that's going to change over time based on your own projections, and you're trying to be internally consistent. Now, if you're wondering, how I change, I don't play games. I just go linear steps. So don't get tricky and say, I'm going to do year 6 and year 7 and year 8. Just pick a point in time where the change is going to start to happen and just put it in 5 linear steps and get them from where they are to where they want to be. It's going to have very little effect on present value to finesse those numbers. So we've got discount rates. Any questions on discount rates? Let's talk about growth. Okay. I'm going to start by laying a grounding proposition on growth that's good to remember. These equations might not always work, but they're good ways to think about where growth comes from. Growth comes from answering 2 questions about a company. How much is the company reinvesting? And you can see why I spent so much time on Tata Motors and how well is the company reinvesting? You're saying, how do I measure that? We already did, right? Remember that return on capital versus cost of capital return. And that's the advantage of actually doing valuation, the tail end of a corporate finance analysis. You have the items you need to answer these questions. So if you're a company that earns well above its cost of capital and earns a high return on equity and a high return on capital, you will grow at a higher rate, even with the same reinvestment rate as another company in the same business. This is where earning high returns on your projects pays off in valuation. It connects capital budgeting to value. So in capital budgeting, we talked about positive net present values, earning well above your cost of capital. But there we were talking in the context of a project. If you do that consistently in your valuation, I'm going to reward you with either a higher growth rate for the same reinvestment rate, or let you reinvest less for the same growth rate, because essentially you'll be able to reinvest more efficiently. So how we measure how much you reinvest will be different depending on whether you take the equity approach or the firm approach. The equity approach, you measure how much you reinvest by looking at the percentage of net income that you as equity investors put back in the business. The old-fashioned way is just use a retention ratio, but the equity reinvestment rate for Tata Motors is a more sophisticated way of saying how much are you putting back. And if you're equity focused, the way you measure returns on projects, you look at return on equity. If you're looking at the entire business, you measure how much you reinvest by looking at net capex and change in working capital. It's the actual reinvestment as a percentage of after-tax operating income. And you measure how well you reinvest with the return on invested capital. Stay consistent once you made the choice. Are you doing equity or the firm? Because everything plays out. Yes. I'd say if in doubt, go with firm, right? The reason being equity valuation gets really messy when debt ratios are changing. Do you see why? Because you got to go, debt issuances, debt repayments. So 9 times out of 10, I look at the numbers and say, look, you know what? I'm safer with a firm valuation, because then if I change my mind about the debt ratio, it's easy to do. Whereas if you do an equity valuation, you change your mind, everything has to get redone. So leave equity valuation for unusual cases, companies that are in steady state, the debt ratio is fixed, maybe a utility, you can say the debt ratio is not going to change dramatically. But 9 times out of 10, you're safer going with a firm valuation. So let me try using these equations, even though they come with catches, to come up with growth rates for my companies. Remember in 2007, I'd valued Deutsche with 2007 numbers with the dividend discount model. My return on equity at that time for Deutsche was 19.5%. My retention ratio was 67%. Banks looked amazingly good leading into the 2008 crisis. We know in hindsight why that was. But if you looked at that return on equity and the growth rate, you multiply the two numbers, the expected growth in earnings you'd have got for Deutsche would have been 13%. What was I missing in those numbers? What were banks doing that was pumping up their return on equity and allowing them to reinvest back in projects? I mean, it came back to bite them in 2000 and later in 2008, which is they were taking riskier and riskier businesses, now undercutting the regulatory capital requirements by finding loopholes. They thought they'd won the game, right? They fooled the regulatory guys. They were able to have less equity and reinvest more. So that basically allowed them to earn the high return equity. But you can fool the regulators, but ultimately you can't fool risk itself, because you invest in risky projects. Ultimately, that risk shows up. And in September of 2008, it did. Every bank, what you saw for Deutsche, you'd have seen for pretty much every bank leading into 2008. Great returns on equity, high retention ratios, high expected growth rate. So you pushed up the prices of banks because they look like machines that could keep delivering growth and profits. In hindsight, would I have done things? No, this is what I thought. So I'm not going to go back and say, you know what, I screwed up. It is what it was. And sometimes when you see businesses with high returns on equity, maybe you need to pause and say, is there something structurally that this company is doing that's going to blow up on them? Because that measures what you actually made, but it might not capture the risks that come from the businesses you entered. I actually, in 2008, when I did this, I was troubled by that 13% growth rate. I said, you know what, this is a big bank, 13% growth for one of the largest banks in the world sounds outlandish. So I did actually take an average retention ratio and return on equity over the previous 5 years. In my valuation, I used the 5.4% growth rather than, I still overvalued the bank, but not by as much as if I just taken last year's numbers and pumped them in. So I looked at an average retention ratio over 5 years, the average return on equity over 5 years. You're saying, are you allowed to do it? In valuation, you make choices. There's nothing that's barred off, right? If you feel it's reasonable to look at a 5-year average rather than last year's number, by all means, go for it. It's framing your story. It's telling you that's the story that I feel more comfortable with. With Tata Motors, if you remember, I had the retention ratio, equity reinvestment rate of 88%. Their return on equity was 43%. Again, I'm a little wary about these numbers. A bank reporting a 43% return on equity. I'm sorry, an automobile company reporting a 43% return on equity. It sounds high for an automobile company. But again, if I just stuck with those numbers, the 2013 values, you come up with 24% as a growth rate. Leading into 2014, Tata Motors looked again really good in terms of growth rates and returns on equity. And much of it came from that 2009 acquisition of Jaguar Land Rover, which they bought at a bargain basement price. That's why the returns are so good, is they bought the Jaguar Land Rover at exactly the right time. In 2009, the world was in crisis. Ford sold it to them at a bargain basement price. It's showing up as this insanely high return. Those returns are still carrying Tata Motors as a company. Without Jaguar Land Rover, those numbers would look much, much, much less impressive. So these are called sustainable growth equations, where you multiply the reinvestment rate times the return on capital. And they're useful, but they have their limits. They're built on the assumption that your margins are stable. If your margins change, these equations will not work. So I want to re-emphasize it. As the margins are changing, these numbers will not work. We'll talk about what to do when that happens. But it's good to get a sense of sustainable growth, because eventually, this is especially as you approach the terminal year and you start to lock things in, sustainable growth will start to govern how you think about growth and reinvestment, because then once you get to terminal, those numbers have to work. The sustainable growth equation has to be driving how you think about growth in perpetuity. Now, if you think about what drives growth in equity earnings, it's return equity, right? High return equity means higher growth in earnings. So how does a company end up with a high return equity? Give me all the good ways and bad ways in which you can end up with a high return equity. What's the best way to have a high return equity in your company? How does Apple end up with a high return equity? Takes insanely good projects, right? But that's so much work and it's so difficult to do. How does a real estate developer end up with a high return equity? You take average projects and you take an immense amount of debt, right? And of course, you add to that cosmetic ways you can make your return equity look good. Like what? You take a big restructuring charge. Look at what happens to your return equity right after, right? You take the restructuring charge, your book equity gets knocked down. Of course, you have a loss that year, but you call it extraordinary. So you count it below the income line. So one-time restructuring charge, and you separate from the rest. And if you're not careful, you can end up with returns on equity that can look great, when in fact you've been taking terrible projects. You just took your mistakes off the books. So you need to be cautious with accounting returns, but let's look at the leverage effect. Why is leverage helpful? Because in effect, you're borrowing money in after-tax terms at a rate less than what you make on your project. A real estate developer makes 9% on a property and borrows at 4% after taxes, is effectively capturing that 5% difference for equity investors, right? That's where the return equity comes up. There's an upside to doing it, which is you push up your return equity in the good times. The downside, of course, is when times turn bad, as they inevitably will, and your return on capital ends up becoming 2%, you still owe the debt at 4%. So the same force that makes your return equity high in the good times will make it terrible in the bad times. Just makes the divergence much wider. So this equation actually just breaks down return equity. It starts by saying, what would your return on equity have been if you'd been an all equity funded company? It's actually a good question to start with, because you can see how much leverage does for the company. And then you add in the leverage effect, which is how much did you borrow with the debt to equity ratio and the difference between the return on capital and the after-tax cost of debt. So this is just a cautionary note. When you look at a company and you see these insanely high returns in equity, take a look at the leverage, because sometimes that will tell you why the return on equity looks as high as it does. So let's think about two companies with high returns in equity. Okay. The first company has a 15% return on capital and after tax. So let's compute return equity for the company. And I've kept the numbers straightforward so you don't have to pull out a calculator. Let's say you make a 15% return on capital. Let me pause right there. If you're a 100% equity funded company, that 15% return on capital will be your return on equity. But let's say this company goes out and borrows money at 5% and has a debt to equity ratio of 100%. Somebody tell me what the return equity would be. So basically you start with a 15% base, which you'd have had with no debt. You're now taking $1 of debt for every dollar of equity and earning a spread of 10% on it, right? The difference between the 15% return on capital and the 5%. You're going to report a 25% return equity. What if you use a 400% debt to equity ratio? I'll let you work out the math, but you're going to get to 50, 60, 70% returns on equity. You know how private equity investors use this in pitches? By focusing on return on equity and IRR to equity investors. They just dazzle you with the numbers, right? Look, 55%. What's the catch though? You get a higher return on equity, but in your valuation, there has to be another shoe that drops. Otherwise, every company will become more valuable as it takes on debt. I'm looking at return on equity. I'm doing an equity valuation, right? What's the discount rate I use? Cost of equity. What goes into cost of equity? Risk-free rate and equity risk premium that I know if you don't change. But this is why we made this big deal about connecting beta to leverage, because if you take a regression beta and just use it over and over, taking on debt will just make you look better and better and better the more debt you take. But if you unlever the beta and re-lever it to reflect the fact that 100% debt to equity, 200 your beta and cost of, the spread you make between your return on equity and cost of equity actually is not changing. You're just raising both numbers as you go up, and that's not creating value. It's just making you an insanely highly levered firm with the chance that you might not make it. Now, in the case of Disney, I'm going to look at, when I look at growth, I'm going to look at growth and operating income. The reinvestment rate, if you remember, was 54%. That's a net capex and change in working capital. Their return on capital was 12.6%. And notwithstanding the caveats with return on capital, looks like they're earning more than their cost of capital. The cost of capital is 7.8%. If they can maintain both the numbers, and this is a big if, their expected growth rate is going to be 54% times 12.6%, which is a 6.8% growth rate. That's a sustainable growth rate, but think of the assumptions that are under it. It's assuming they will continue to reinvest like they have in the past, that they will maintain the same margins that they have in the past. I know lots of ifs, but if you can maintain those, that's what your growth rate is going to be. Yes. No, because remember, if your reinvestment rate is 54%, 47% is being returned, right? Some of it is returning to debt holders, so that actually includes a fairly rich dividend and buyback in there, right? If that had been 100% or higher, the reinvestment rate, then I'm assuming nothing is getting reinvested. I'm actually raising capital. You know why it's good, even if you don't use the sustainable growth rate to calculate? Let's say I'm a Disney analyst, and I tell you there's going to be 25% growth in operating income at Disney. The sustainable growth rate is 6%, 6.8%. What are the kinds of questions you're going to ask me to see if I just made up the 25%? One is, are you reinvesting more, right? But that alone is not going to do enough, because even if I reinvested 100%, I'm still going to be capped at a 12.61%. You're also, maybe I'm assuming the return on capital will go up from 12.61 to 16 or 18 or 20%. And you got to put me on the spot and say, what are they doing that's going to allow a company of this size and this history to suddenly change return on capital? It gives you ammunition to challenge people when they assume a growth rate and say, that makes no sense. This company reinvests almost nothing. So what are you assuming that's going to allow that growth to emerge in a company? So I use it almost as a benchmark that I can use to compare what people are projecting, say, what are they assuming about either reinvestment or return on capital that's going to allow them to come up with that higher growth rate. So with that long lead, and let me talk about the most general way you can do valuation, because I said that sustainable growth equation requires stable margins. I'm going to assume that 90% of you have companies that have unstable margins in one direction or the other. If you're valuing a young company, you expect margins to increase over time. So if you might be valuing Netflix, you might say, I think economies of scale are finally going to kick in, margins will improve. Or if you're valuing a mature company, which is being disrupted, you might expect margins to decrease over time. Margins can change. Here's the most general way to think about valuing companies when everything is in motion. Remember the previous approach, I stayed with operating income. I never went to the top line, revenues. You know why? Because if margins are stable, why do you never have to forecast revenues? Because what you see in operating income is also going to be growth in revenues. That's a nice thing about being in stable margin. You can focus entirely on earnings. If your margins are changing, you have no choice but to start with forecasting revenues. We'll talk about what will go into the forecast of revenues. This is your growth part of your story, the revenue growth story. The revenue growth rates will make your margins change or your revenues change over time. Second stop, you told me margins are going to change. Give me a sense of direction. They're going to go up or they're going to go down, and be more specific as well. Can you tell me if they're at 8%, they're going to go to 12% or 15%? You just have no idea. Then you're really not ready to value the company because you haven't completed your story. You have to look at the business they're in, and we'll talk about some of the factors as to whether you can go from 8 to 12 or 8 to 50. Because if I let you pick and you wanted a high value, just pick 50%. We'll talk about what constrains you in that choice. So you start with revenues, you forecast margins, and then you still have to bring in reinvestment. But here you got to tie reinvestment not to operating income like we did in sustainable growth, but to revenues. Do you see intuitively why? Because if your margins are going from small to large and revenues are what's driving growth, you're going to think about what do I need to reinvest to get that revenue growth? I'm trying to hold you accountable on your story. Because in the first part of the story, when I say, hey, what kind of revenue growth you want to use for your company? Let's say it's your own company. You say, I like a high revenue growth. It's okay. Pick a number, 50%. So what kind of margins would you like? And again, if I gave you the choice, I'd like an 80% margin, okay? And then I'm going to circle back and say, you want a 50% revenue growth, you will need to build new factories, right? Invest more in R&D. This is my way of saying, you want a high growth rate. Do you have the capital to do it? Are you willing to dilute your ownership to do it because you will need fresh capital? Revenue growth, margins, sales capital. So if any of you have opened the FCFF simple Ginzu spreadsheet that I sent you, each of your companies, those are the three inputs I make you zero in on. What's your growth? What's your margin? So I want to talk a little bit about the thinking that goes into, do you use a 20% revenue growth rate or a 50% revenue growth rate? So let's start with revenue growth. What are the things that drive how much your revenue growth will be? First is what the size of the market you're going after is, right? If you're a company in a small market, a niche market, your total market is not that big. But if you're a company in a very big market, it could be China, it could be AI, it could be whatever big market you call automated driving, this is called total addressable market. It's become this buzzword that a lot of IPOs use. And they play games with it. But if you're realistic, that's the market you're going after. So to assess how big that market will be, you're going to start with the current size of the market. Sometimes that's easy to get if the market is primarily composed of publicly traded companies. So if you wanted to get the current size of the automobile market, and you have access to S&P Capital IQ as you do, how would you get the current size of the automobile market? It's almost entirely publicly traded, right? You take the revenues of every automobile company, and you can get them on Capital IQ, and you add them up. That's the size of the market right now. As opposed to what? As opposed to when I first valued Uber and I wanted the total addressable car service market. In 2013, when I valued Uber, you know what car service looked like around the world, right? Who delivered car service? Cabs, limo services. The problem there is none of them were publicly traded. They're all private businesses. So you couldn't go to Capital IQ and say, give me the revenues of each of these cab service. I had to go city by city to taxi and limousine commissions in each city because they keep track of them. And it's a pain in the neck. So sometimes it's easier to get than others, but you need to start there. What is this market size now? And then you have to ask a question that I wasn't very good at asking in 2013. Could that total market change over time? Why? Because you're changing people's behavior and taste. Maybe that market that's now 100 billion could become $1 trillion. The car service market. This was a point where my valuation, Bill Gurley, who's a partner Benchmark Capital, contests my valuation. He said, you're missing the fact that the car service market itself could get much bigger because of services like Uber and Lyft. What is he talking about? I mean, how many of you use Uber and Lyft? Right? Almost everybody here, right? I mean, how many of you use yellow cabs? Glad there are a few people left. I haven't used a yellow cab in 10 years. But increasingly, the market is dominated by the Uber. It's changed the way you use car service that you have Uber and Lyft on your phone all the time. You're half a mile from your apartment. It's 11:30 at night. In the old days, calling a cab or hailing a cab was such a pain in the neck, you probably walked home, right? Now you're half a mile. You say, oh my God, I feel really tired. Let me call an Uber. Surge pricing, but your legs are worth at least $15, $20. In the Bay Area, where ride sharing has its deepest roots, it's estimated that the size of the car service market has tripled over the last 15 years. Why? Many people who move to the Bay Area now no longer buy cars. It's estimated that 35% of the people who live in the Bay Area, young, they can afford, I mean, they make hundreds of thousands of dollars. They don't bother buying a car. Why? You're lifted, they're right, Uber and Lyft are ubiquitous. They're 3 minutes away. Why buy a car, pay insurance, find a parking spot for it? And in San Francisco, you got to park uphill or parallel parking. No, I don't want to do that. Let Uber deal with that, right? It's changed the way people behave. That's what I missed in my 2014 Uber valuation. And it's a lesson I brought in when I valued Airbnb, because there I started with the hotel business, the size of the market. By adding up the revenues of hotel companies, I came up with like 700 billion. But the total addressable market I used for Airbnb was almost twice that, because I think people are traveling who would never have stayed in a hotel would be willing to use an Airbnb. So when you think about total addressable market, in some markets, it's going to be just the current market growing at the inflation rate. You're doing Coca-Cola, the beverage market is not going to double or triple in size. It might change in composition from sugar drinks to, water from Iceland or whatever, but basically, it's not like people can drink 3 times as much. If they are, maybe you should invest in restrooms then as your second investment opportunity. But the total market and it's subjective. It's a judgment, but it's going to be the first thing you look at. Second, to see how much your company can grow in that market, you got to first look at its market share. Why would that matter? Let's say you have 2 companies. One has a 40% market share, the other has a 4% market share. Which one are you going to give the higher revenue growth rate to? The 4%, because the 40%, you're already at 40%. It becomes much more difficult for companies to grow as they become larger shares of the market. Uber and Lyft better hope that the ride-sharing market continues to grow, because this isn't 2013 anymore, where you were taking market share away from traditional cab companies. You now are the car service market. I was actually looking at Uber's earnings report yesterday. It came out after close of trading. Their revenues were up 7% over the last year. It's telling me the market is starting to level off. This is now maturing as a market. So when I project out growth for Uber, given that it has the largest market share of the market, I'm going to be wary about putting in a 20% growth rate. Unless I can find some new business that Uber can go into. Because right now it's Uber and Uber delivery. Maybe I can bring in Uber moving, but market share is going to be one of the things you look at. It's also going to depend on the kind of industry you're in. What does it mean? There are some industries where you end up with 15 or 20 players because the nature of the business is splintered. I'll give you an example. The cement business, incredibly splintered. You know why? Why don't we have one gigantic cement company that delivers cement all over the world? Any of you picked up a bucket of cement? Don't try. A bucket of cement weighs like a ton. Cement is just incredibly difficult, expensive to move. So cement has to be localized. The Greek cement company has an incredible advantage over a German cement company in Greece because you're closer to the market. So the cement business tends to be splintered because of the nature of the business. Traditional advertising, where you did billboards, used to be localized. Why? Because you know the market, you know where to put the billboard up. Online advertising is globalized. So this is what we talk about when we talk about network benefits, which is there are some businesses where you're going to end up with 2 or 3 big winners. And in fact, become the feature of many of the new technology businesses is you don't end up with 15 players, you end up with 3 players because of the way the business evolves. It's what makes Scott Galloway mad, but let's face it, it's industry economics driving it. So if you're in a business where you think there are going to be only 2 or 3 winners, first you got to make a judgment on whether your company that you're valuing is going to be one of those winners. Because if it's not, now if you're valuing Snapchat, you said, you know what, it's going to get squeezed over time. It's going to show up as a low growth rate and essentially the business is going to go under. But if you think your company is going to be one of the winners, you can see potential gain for growth in the business. Now, I am curious about how the streaming business is going to play out, to be quite honest. I don't see a world where you're going to have 8 different streaming services because some just cannot compete. I mean, I opened up and I got a trial subscription to Paramount streaming. I look and say, look, I could watch what I want to watch in about 24 hours and be done for the whole year. There's not enough stuff in here for me to stay on. I think the streaming business is going to get consolidated. The 2 biggest players are Netflix and Disney right now, and eventually you're going to see a bundling of streaming to have, you know, maybe 3 or 4 streaming services. But that's going to drive what kind of growth rate you give a company. And finally, you need to understand what makes your company special. So if you're valuing Uber in the ride-sharing business, you say, what makes Uber different? What makes them special? The biggest thing might be they're already there. They're already the biggest player in most markets. It's a first mover, biggest player advantage. It could be that they have a patent or a license that only they can grow in this market. You're looking for what can I latch on to give them a higher or a lower growth rate. So look at the total market. Look at where your company stands. The potential for revenue growth is going to be greater in some companies than others, depending on where you see them evolving. Second, growing revenues alone doesn't make you a more valuable company. You've got to also make money. So I'm going to ask you, I know the company is losing money or makes very little money now, but what will the margins look like once you've gone through the pain? Again, not an easy number, but it's a number you need to kind of confront. So let's think about what will go into whether you give your company a 50% target margin or a 12% margin. Remember, I said as a founder, I'm going to come and ask you what kind of margin would you like? And you said 60%. Then I'm going to ask you, what kind of business do you run? If you say a manufacturing business, I'm going to say, sorry, can't give you 60%. Why not? Because the unit economics just don't work out. You know what unit economics is, right? On that extra unit that you sell, how much do you have to spend to produce the unit? If you're a manufacturing company, you actually have to make the damn thing. And if your cost of goods sold is 70% of what you make, your margins can never, at the absolute maximum, cannot exceed 30%. They're probably going to be more likely to be 8 or 9% if you have 30% gross margins. As opposed to what? As opposed to being a software company. What does it cost you to make the extra unit? Absolutely nothing. Software companies can end up with 40, 50, 55% margins. Intermediary businesses versus traditional car service businesses. Intermediary businesses, an Airbnb was going to have much higher margins in steady state than a Marriott. I'm not saying it's a better company, but it basically is a different business model. Tariq? Yeah. How do you quantify profitability for any company? You make your best estimates based on what you know today, right? That's all you can do. You look at the market, you make judgments on, which are the streaming players that are going to win, how much do people spend? Ultimately, people spend on streaming. So there's a budget constraint, right? If you build in a model where people are spending $2,000 a month, the average American is spending $2,000 a month on streaming, I'm going to say, you know what, that's not going to work because they have to eat, they've got to live somewhere. There are all these other costs in their budget.
But sometimes you see people kind of forget about the fact that the market they're projecting comes out of somebody's pocket, right? Somebody's got to pay for it. Advertising has a cap. Why? Because it's an expense to the companies that spend it. So if you tell me advertising is going to triple in size over the next 10 years, the total market, I have a problem. Because where do companies come up with all that extra money to spend in advertising? So that's why with a market like advertising, you're not going to get a huge shift in the total market because somebody has to pay for it. Okay? So there's no easy way. Some companies, it's easier than others, but you got to make your best judgment. So the margin part, you're going to look at unit economics. You're going to look at economies of scale. Tell me in intuitive terms, what does it mean when you say economies of scale? Where would I see it in your financials? Revenues grow at a higher rate than the expenses grow, right? That's the bottom line. So when a company says we have economies of scale, what's the first thing you need to do? Look at the history, look at the growth in revenues, look at the growth in expenses. If the revenues have grown 35% a year and expenses have grown 40% a year, your response is stop talking about economies of scale. It's a nice sounding word. This has been the bane of ride-sharing companies through their entire existence. They've been able to grow revenues. They've found that magic to grow revenues. But the problem is that expenses grow more than proportionately. They have a business model that doesn't create economies of scale. And you can see why, right? Because what's the cost? They have to pay out, they get to keep 20% of the fare. So basically, it's not like you get huge economies of scale. There are no big fixed costs that Uber headquarters, that economies of scale very quickly played out. But if you have a business with true economies of scale, it could be a business which has large fixed costs, probably more manufacturing than service businesses. You could argue that as you increase revenues, you now get the... No, Netflix has much better economies of scale than Spotify does. You know why? There's a reason. It's rooted in how Netflix and Spotify pay for content. Netflix pays for content. It owns the content or rents the content. How does Spotify pay for content? It's actually based on how many times a song gets listened to. So if you're Taylor Swift and everybody's listening to you, you get a huge amount of payment. It makes that content cost into a variable cost, right? Because now if you sign more subscribers, the costs are going to go up because they're listening to more music, you're paying it out. So Netflix, as it grows subscribers, you can make an argument for economies of scale that's much stronger than with Spotify, because as Spotify grows, the content cost will also grow with it because of the way that... So when people pick more flexible costs, and Spotify picked it because it was less risky, right? You don't have this big cost. It comes with that downside, which is you're not going to see margins pop at Spotify as much as you do at Netflix because of the way they've structured their costs. So when I talk about telling a story about a company, if you pick Spotify, that's one of the things you want to look at. How do they pay for content? That's the biggest expense, because that's going to frame what you think of as the target margin for the company. And finally, you're not the only player in this game. One of the things I find troubling in valuation is when people pick a story and say, AI will reduce my costs. Okay. It'll increase my margins, not so fast. Why does the second not always follow from the first? When somebody says, if this will reduce my cost structure, why doesn't it mean that your margins will go up? Well, the question is, did the cost go down just for you or for everybody in the game? If the costs go down for everybody in the game, if everybody has it, nobody has it. I know it sounds like an odd thing to say, but let's say AI reduces costs at any human services-based company by 30% at every company. You're saying this is good. All those companies will become more profitable. Not really, right? Because all you need is one player to say, we have much lower costs. I'm going to cut prices. And once one player cuts prices, guess what? Everybody has to cut prices. I'll make a prediction. AI is going to make companies collectively less profitable. I know it goes counter to it. The only companies that will benefit are the companies that sell the AI stuff, but the companies that use AI in there, and they have no choice. They have to play the game. I mean, the analogy I would give is like getting ready for the SAT. My wife took her SAT in 1981. She just walked in. and took the SAT. Never seen a practice test before. Today, if you think about the architecture for getting ready for the SAT, like 3 years of preparation, 100 different tests you took. Does it mean you're better off now than others? But everybody else is doing exactly the same thing on a relative basis. Nothing has changed except for the fact that I've ruined 3 years of your life now, making you take SAT prep. So when people talk about this great stuff that comes out of AI and the cloud, I think sometimes they miss the fact that if everybody has it, it actually makes things more difficult for companies to preserve. So when you tell a story about cost dropping, if it's something that's exclusive to your company, then it can be a reason for margins going up. But if something that applies across all companies, you've got to be wary because the competition is going to determine what will happen to margins. So those are 3 factors you look at for the target margin. And let's say your target margin ends up being, you're a software company, 33%, but right now you're at 6%. Take Snowflake, right? Cloud software, lots of potential. They're at 6%. You think they can get to 33%. That's the pathway you map of how they get from 6 to 33 affect the value. What's your best case scenario? They go from 6% this year to 33% next year. Not likely to happen, but if it does, that's the best case scenario from a valuation perspective because your earnings are going to pop right away and you get the entire benefits. Your worst case scenario, you go from 6 to 33 by going 6, 6.3, 6. It's very difficult to improve margins early on, but later, years 8, 9, and 10, you go to 33. You have the same end target, but very different valuations. Now, one of the inputs I ask you in the spreadsheet is when will you get to the target? That's my question of, are you a company where the pathway to profitability is going to be smooth and quick? You're already set to improve. In which case, you can pick year 5 and you go 6 to 33 in year 5. Are you the kind of company you're going to struggle to get from 6 to 33? You can put it in year 10. Again, you can see the answer will depend on your company. It'll depend on what you start with. The lower the number you start with, the more work you have. It'll depend on choices you make, right? Because what do you need to do to improve margins? You got to focus on margins and profitability, sometimes at the expense of growth. Remember, you got the revenue growth number and you wanted to use a really high number? When you use a really high number, sometimes that might mean making less profits for a longer period before you see the improvement because you want to go for revenues first. Doesn't make it better or worse, it's just a choice. The Amazon model, right? I call it the field of dreams model. If we build it, they will come. If we build what? The revenues, the margins will improve. And finally, it'll depend on what your business model looks like. As I said, some businesses, the margin improvement comes quickly because the costs are very, very, very insensitive to revenues. Revenues just grow. The unit economics kick in. So when you think about margins, factor those in. Again, if Tariq's question of how do I know, that's the existential question you face anytime you value a company. You got to get over it, right? Because you have to make the best judgment. And here's your consolation prize. Are you going to be wrong? 100% of the time. How wrong? Horrendously wrong sometimes. You think this, then why do it? Because everybody else is in the same place you are. You think there's somebody with a crystal ball and Snowflake who know, we're all in the same place of having to make the best judgments we can. And all you need to do is be a little less wrong than everybody else. And you're on the right track. And finally, let's talk about reinvestment. This is the number that's trickiest for people because it's not a number you're familiar with. I'll tell you what it is. It's the number of dollars of revenue you get for every dollar of capital you invest. So if you're an efficient investor, you should get more dollars of revenue. The higher the sales to cap ratio, the less you're reinvesting to get the same revenue growth. So the question I'm asking is, how efficiently can your company deliver this future revenue growth you're projecting? So here are some of the factors to think about. One is you can look at the company's own history, right? For change in revenue, how much they have to invest in capital. And in some businesses, that might be a low number because you have to reinvest a lot to get $1 in revenues, but you get high margins. So in other businesses, it can be a very high number. It measures the capital intensity of your business. But here are some of the things I would like you to think about with your company. There are some companies where as you scale up, capital becomes more efficient. You get higher revenue growth for every dollar of capital. Give an example, infrastructure companies. Initially, their sales to capital ratios look awful, right? You're investing huge amounts, you get very little in capital. But as you've scaled up, it actually gets easier and easier because now the marginal costs of adding to revenues become much lower. So you start with low sales to capital ratios and you will see them rise over time. And in a variant of that, if you have a company that builds a big factory, right? You have huge capacity. When you're at 30% capacity, your sales to capital ratio is going to look awful. So if you have excess capacity, as you use that capacity, you're getting those additional revenues at very little investment. In fact, this is, I think, the big question with Netflix, right? If you view what they've already invested in content as the end, right? They've got enough content. Now you can live off it. They should be able to get huge amounts of revenues with little capital. The only problem is where the places where they're trying to grow, they need to create new content. If you notice, almost 30% of the content now is either Indian, in Indian language, because that's where they're growing. You see that, so it's almost like they can't get off. I mean, I've described Netflix as a hamster on the wheel. They can't get off the wheel. They need to keep investing. So if you're an optimist on Netflix, you're looking for that break point where they can stop growing content at the same rate as subscriptions. But that's also going to drive the sales to capital ratio. So if you think about these three numbers, they capture pretty much any business model you come up with. The growth part gets captured with the revenue growth number. If you're upbeat about growth, that's where you show. The margin part gets, the profitability part gets captured in the margin. Your high profit business, a high margin. And the efficiency, the capital intensity of the business gets captured in the sales to capital ratio. So here's an example. This is from a Baidu valuation in 2013, and it reflects my expected growth rates, margins, et cetera, over time. And you can see my growth rate is going to be high. Why? Because they're in the Chinese market. The online market is growing 25% a year. They have a high market share, but the market itself is growing. That's really the only reason they're able to grow, because they're already a dominant market share. Along the way, they're facing competition from two big players in 2014, Tencent and Alibaba coming after their business. So over time, I think their margins will decrease. That's a competition kicking in. It's more than offsetting. There are no economies of scale left at this point. Margins are decreasing. And they will have to continue to reinvest in R&D to keep their search engine on top. So I've assumed that they can maintain their existing sales to capital ratio. High revenue growth, margins under pressure, and continued reinvestment. Is this an upbeat story? It's a fairly upbeat story of growth, but it's a story with, there's an upbeat component on growth, but margins are over time going to shrink, and that's affecting my valuation. If in contrast, you look at Baidu and said, you know what, I think they can maintain their margins. Alibaba and Tencent have different businesses. This is an online advertising company. They don't have to worry about it. Your value will be higher than mine because your target margin will end up being higher than mine. This is a debate on the right issues. It's about, hey, what kind of company is this? What do I think they will end up looking like 10 years from now? And that's driving the numbers you see in the valuation. Which brings me to the final piece of the valuation puzzle, which is you wrap things up, right? You get a terminal value. And of course, that equation is perhaps the most misused equation in valuation, where you take the cash flow in year 11 divided by R minus G. First, when you do that, you come up with a number. That number is going to be by far the biggest number in your discounted cash flow valuation. If that sounds familiar, that's what happened to the Disney theme park too. Remember when we did the terminal value, it's the biggest number. Is that good? Is that bad? It is what it is. I know some people make an issue. My 80% of my value comes from the terminal value. So what? When you invest in a stock and it turns out to be the right stock to invest in, think of how you make money. It's not when you hold the stock, it's when you sell it. Terminal value is a stand-in for price appreciation. And the more you're dependent on price appreciation to make money in a stock, the greater the percentage of your value is going to come from terminal value. So I have a series of 5 posts. I'll send you the links on terminal value because, as I said, there's a lot of mythology about terminal value that I want to dispense with. The first is that the only way to estimate terminal value is to assume growth in perpetuity. That's what you see as the standard R minus G. That's not true. You get to year 10, Rather than assume cash flows continue to forever, can you assume that cash flows will continue for another 15 years in it? Yeah, there's nothing that stops you. The fact that you don't do it doesn't mean it cannot be done. You say, why would I do that? The perpetual growth model was designed for companies with really long life cycles. Like what the standard 20th century company, right? It was successful, 130 years from start to finish. When you last 100 years or 80 years, you can use a perpetual growth model because it's an approximation of what you'd get if you use 70 years or 100 years. Think of how long Yahoo lasted from start to finish, right? 1992 to 2015. 23 years. You get to year 10 of a company like Yahoo, and you assume a perpetuity, you're overestimating the terminal value. Now, if you're valuing a Zoom or a Peloton, I don't know about you, but I don't see Zoom as a perpetual technology. Its platform is going to die at some point. It's not a bad thing or a good thing. Technology-based companies have shorter lifespans. Look at how quickly Google displaced Yahoo. You know what's terrifying Google? Is they remember how quickly they displaced Yahoo, and they said, please God, don't let Bing displace us just as quickly. What makes scaling up easy is going to make scaling down easy. So leave open that possibility that you don't have to use a perpetual growth model. Second, I've been told that the terminal value equation can give you an infinite value. When does that happen? It's cash flow divided by R minus G. So let's say your discount rate is 8%. Your G is 3%. You get a value, right? You try 4%, your value goes up. And you can't stop yourself. You go 4, you go 5, you go 6, you go 7, you go 7.7, 7.8, 7.9. As G approaches R, you get what I call Buzz Lightyear valuations to infinity and beyond. You go, right? Because that's what's going to happen. It should never happen. Why? Because you assume a growth rate in perpetuity. It shouldn't be getting up to 7.9%. That's why we put the risk-free rate as a cap on the growth rate, is to prevent that infinity value. And final 2 points were, the fact that it's, when you look at the terminal value, it's a big proportion, let it go. It's going to be a big proportion of value. For growth companies, it's going to be an even higher proportion, not a big deal. Are you allowed to have a growth rate which is negative in perpetuity? I mean, no, the cap is the risk-free rate. You can't be above 3.3% now. Is it a growth rate of 2%, 1%? Is that okay? How about a 0% growth rate in perpetuity? You're making your company shrink in real terms. Can you put in a minus 3% growth rate in perpetuity? I don't see why not. You're valuing a fossil fuel company or a tobacco company. You can put in a negative growth rate. It's more realistic. So you get a chance, get your numbers into the FCFF simple Ginsu spreadsheet. Send me your values. Essentially, it's going to reflect your story. Okay? If you're uncertain, that's typical. You will be uncertain, but let it go. Yeah. Yes, go ahead.
What are negatives? Not you also add up some negative value. You can't go less than 0.
You can go less than 0. You put minus 3%, you still get a positive.
No, but in terms of value, right? So your value goes down as the time progresses, right?
Right.
When you put a negative,
so you go down close to 0. So basically, you create the company.
but you would never get below 0.
Never get below 0 because it'll approach 0,
I see.
but it won't get below 0.
I understand. Okay.
I have a question. So my company has a very huge research expense. So it's considered reinvestment, but it's not going to go into the reinvestment equation because it's not under operating by expense. Or
You
how
can
do
capitalize research in that spreadsheet.
So under operating expense.
There's an option in the spreadsheet.
Okay.
For the capitalize.
Yeah, I had indicated
So
that.
you've got to capitalize it. Otherwise, don't mess it.
Okay, so you just add.
You can't just add the R&D to reinvestment. It's not as simple as that, right?
Okay.
Because you got to adjust your operating income, you got to pay the research asset, you got to depreciate. It's a little messier.
Okay,
You want to bring R&D into the capex. use that option. I want to convert R&D.
Okay, yeah. I saw that spreadsheet, but because depending on the number of years that you pick, the value varies a lot. So
You gotta remove it, you have pharmaceutical company. It's not an
So I'm-
it's not an option,
okay.
right? It depends on the business you're in. You're a
Yes.
software company, you don't have a 10-year amortizable life, you're talking about 2 to 3 years. So
okay,
when you tell me the business you're in, the R&D will come with the life that reflects the business.
okay. I'm doing NVIDIA and
Probably 3 to 5 years.
to 5
to get
years.
most people
Yeah,
asking.
Okay.
Companies fund for the
Thank you. And just one more question on this slide. So I'm just wondering, how do you get from sales to investor capital to the reinvestment ratio?
You don't do a reinvestment rate. When you do revenues, margins,
Yeah,
reinvestment, you don't need a reinvestment rate. Your reinvestment will come from your sales. That's the whole point of the sales to capital. Is
okay,
it's not a percentage of your after-tax operating income that you reinvest, it's connected to your revenues.
okay. So this is from the revenue perspective, whereas the
Ultimately,
reinvestment rate.
there's no revenue perspective. It's connected to revenues because your reinvestment is a function of what's happening to revenues. It's still reinvestment.
Yeah,
It still affects your cash flows. It still has the same
Yeah.
effect. But how you compute it
Mhm.
is different because you connect it to revenues instead of operating income. The
got it.
reinvestment rate connects it to operating income.
Yeah,
um,
but this one is
disconnects it to
connected to
revenue.
investor capital. So,
Hmm.
so is it like,
Change in invested capital is
change-
reinvestment.
okay,
It's the same thing.
so it's just one is from a balance sheet perspective, another from a income
No,
statement
they're both from
perspective.
the income statement. It depends on
Okay.
which item. in the income
So how do
statement
you
connect it
choose
to.
which one, which of the ratio to use?
If your margins change, you have to connect it to revenues, right?
Yeah, that's right.
Right, so if your margins are changing,
Uh-huh.
connecting to operating income makes no sense. Because your
Right.
operating income can improve because your margins are improving. You don't need reinvestment for that. Reinvestment comes from what you're growing, right? If your margins are changing, it should always be connected to